I'm Dr. Dave Janda. Welcome back to the Insider Insight Show. I am honored to have back with me someone who is a very dear friend and someone who is your very dear friend because, well, he actually started with a career in the financial services sector and decided to take an early retirement and venture into the world of entrepreneurship. And every person in our country, frankly, every person in the world should be grateful that he did that because he established a platform, TF Metals Report, that is second to none, tfmetalsreport.com. He has developed an entire community of people in that platform. And it's a platform that is based on educating and empowering every person as it relates to not just the financial world, but what's really happening around the world geopolitically. I encourage you to go to tfmetalsreport.com. I encourage you to become a subscriber because that is where you get the insight of many years' experience from my next guest, Craig Hemke. Craig, welcome back to the Operation Freedom platform and the Insider Insight Show.
Doc, thank you. I value your friendship over all these years and very much appreciate the kind words about my business here at tfmetalsreport.com. It's about twice as expensive as a Netflix or a Hulu subscription. But I think it's probably more valuable in preparing you. I mean, there's value in Netflix as a distraction these days. No doubt about that. But in terms of preparing you for the certain events that are coming, I just don't think there's anything more valuable out there. So thank you.
So, Craig, in my field of medicine, one of the issues that we try to help people with is to become cognizant of potential issues at hand, of what's occurring that they might not be cognizant about. And I believe it's also true of your world and the financial world. So, Craig, when you survey the landscape around our country, around the world, what's the number one issue in the financial world that you believe people are completely unaware of that could potentially have significant deleterious effects on their lives and their future?
Well, I would change that to will have, not could potentially. There are going to be deleterious impacts from what is coming. And I, to some extent, the individual is at fault for maybe not having, and they were never given an education on this stuff. You maybe took a civics course in high school, but not a lot of people, and because they don't have, people have varying interests. So they don't really have an economics background or a business background, or finance background or whatever to be able to see what's going on and then understand the implications. Okay, the other part of this is, life is hard, man, right? We know this. I mean, I think of, my neighbors or my friends. Life is, who has time to stop and consider and connect the dots? When you're chasing around trying to take care of your aging parents, maybe you've got kids that are in college or just starting out, or little kids, that are taking all of your time, taking care of them. You got a mortgage payment. You and your spouse are both working, trying to somehow make the mortgage and save a little money. I mean, it is very easy to be caught up in all of that and not have the time to fully consider all of these things and the mathematical certainty of what is coming. And so I think there's a kind of a normalcy or a recency bias for most people. We've had crises. Most recently, like the great financial crisis that was just kind of papered over, no pun intended, to keep the wheels spinning and the plate spinning and the wheels turning. But there comes a time when tomorrow will no longer be just like yesterday. And I think it's not really a complacency. It's it's more of just a normalcy bias that people have. And what I mean by that is, in my lifetime, in your lifetime, and in everyone who is listening to us in your lifetime, the only world you've known is the U.S. as this economic superpower. with control of the global currency that all other countries use for trade, with lower interest rates and cheap money flowing into all kinds of assets, whether it's, stocks or your home or whatever. And everything, though inflation is insidious and taxes keep growing, and now, two people have to work to provide enough income for a family that one person could 50 years ago. Mm-hmm. It all kind of seems normal, frog in a pot kind of stuff. Mm-hmm. But the time is fast approaching where the U.S. is going to begin to lose that, those privileges and that superpower status. And the deleterious impacts, as you said, are certainly coming. And I don't think people have positioned themselves or have protected themselves in a way, they'll be able to see their way through that.
So we have a holiday coming up here in the United States soon, Labor Day holiday, get together for friends and family. I would anticipate that the vast majority, if not the entirety of our listenership is aware of potential issues as it relates to the dollar, possibly no longer being the only reserve currency of the world and the like. At the Labor Day picnic, family picnic, with friends and family, what do you suggest our listeners do in trying to help educate and therefore help empower those that might be stuck watching Fox Business News occasionally reading the Wall Street Journal or CNBS or the like?
Well, if your fuzzy-headed brother-in-law or your neighbor or whomever has enough of a financial understanding that they'll know what the hell you're talking about, which is a big assumption, right? Because a lot of, it's like me talking to a doctor like you, Dave. I'll sit there and nod my head and go along because I don't want you to think I don't know what you're talking about, right? That's kind of embarrassing. I don't want to, my brother, I'm talking to somebody about economics and they think, well, I don't want this, I want Craig to think I'm some kind of dope. So they'll nod and play along like, just like they could talk to me about whatever they do.
Right.
And I don't know what, like you, like a doc. Oh, yeah, okay, doc. Yeah, I understand. You're going to put the scalpel right here and you're going to cut in and you're going to, So if someone, though, really does you feel like they do actually understand, they're not just placating you and nodding their head, then for that person, I would try to explain the math of it all. Mm-hmm. Even the Congressional Budget Office, Dave. Mm-hmm. Which, and how specious their numbers are sometimes. But even they say over the next 10 years, the U.S. is going to add, on average, about $2 trillion worth of debt to the pile, taking it to over $50 trillion by 10 years from now. And if you break that out, that's $5 billion a day of new government debt, okay? Now, Jerry Powell and his ilk have had it pretty good here for the last 18 months. They've been hiking rates and, they look so smart. The economy is doing fine. But all those rate hikes have lagging effects. What is eventually going to happen is the existing debt that's already 30 some odd trillion dollars that is financed at 1.5 or 2%. And so, the government is only paying $600 or $700 billion a year in interest on that debt. As rates go up and that has to get refinanced at 4% and 5%, that number just explodes. Then your economy is slowing down. So the only income, if you want to call it that the government has is taxes and fees. And that starts to go down because the economy slows. And then the whole thing just starts spinning that much faster. Okay. So I think you can have get somebody that base understanding of the terminal phase of this. And then you can have a discussion from there. Now, the other thing I would say, Dave, if you're just having a discussion with, your nephew. I was thinking about this morning. I have a daughter that just got married, and she and her husband are thinking about buying a house or a condo or something like that. And it is like the worst time. The financial conditions for home buyers is like the worst it's been since the 1970s or something like that. I just saw that chart yesterday. And I was thinking, I really have to. They're coming to town this weekend. I really have to explain that they'd really be better off waiting a couple of years. Because what's happening right now, and again, this would be for somebody that, you can't have a discussion about the actual economics of it all.
Mm-hmm.
So, hey, do me a favor. Don't buy a house right now. There are no sellers of existing homes.
Right.
As we record this today, today's the 22nd, existing home sales came out and they're falling sharply. Well, why?
Mm-hmm.
Because people, I have a mortgage at 2 7/8%, Dave. Why in the hell would I sell my house, let the bank off the hook for that?
Right.
We'll get less house at 7.25 or 7.5 and have a higher payment for less. It doesn't make any sense.
None.
So existing home on the market is falling dramatically. So what's happening? But there's still demand, like from my daughter.
Mm-hmm.
And so new homes are being built like crazy. And all that is doing is that's dragging forward the supply of new homes. Homes that should have been built, providing jobs and demand for, all the inputs that go with a new house over the next couple of years are all being built now in the next couple of months. Eventually what happens is we'll have this massive glut of homes. As the economy slows and rates come back down, all of a sudden people with existing homes are going to like, well, I am going to sell now. I have all this glut of all these new, and home prices are going to crash. And we're going to have another housing crisis like we had in 2008 and 9. And so anyway, that's a really long answer, Dave. But I think you can have, based on, I guess, a level of, I hate to use expertise because that makes it sound like it's overly complicated. Based on a level of understanding, you can either have a discussion about how we're really in the terminal stage of the debt, that the government's going to start paying $1 trillion or $2 trillion a year just in interest, or you can just have a discussion of, what, now's not the time to be buying a house. If you can just wait, if you can rent for a year or two, home price is going to come down, rates are going to come down in the short term, and then maybe you buy something. Anyway, long answer.
And over the years, the magicians, the financial magicians, have always massaged the numbers of the economic data to placate people and to keep them in the dark. But Craig, maybe I'm just optimistic on this, but my impression is the vast majority of the public is starting to figure that out, if not already figured it out, that the numbers they're being told are in fact bogus. Am I off on that?
The only word I would change in your sentences or words would be vast majority. I'm not sure we're at there's even a simple majority of the general public that understands this yet. Well, for a number of reasons. Like I said, a lot of people are just busy, right? They don't really take time to think about it. When they do think about it, it's because Lester Holt said something on the nightly news about how GDP for the second quarter, or how jobs, the U.S. economy added 200,000 jobs in July. That's the extent that they think about it. So I'm not sure that we're at that point yet of a vast majority. And you remind me of a question I got in an interview I did last week. Remember last year, there were 2 quarters in a row where GDP was negative?
Correct. That's a definition. That's a standard definition of a recession.
It always was, yeah. And instead you got, oh no, that's not how you define it. Right. And I was thinking about that while I was answering this question, and I think that's, as I've thought about it in the week since, I think this is right. I think a recession now it's a little bit like the old saw from the late 70s or the 80s about what is pornography. You can't define it, but you know it when you see it.
Right.
Well, that's kind of what a recession is going to be. People want, there will always be political economists and news organizations that, from a political standpoint, want to convince you that everything's normal and fine. We used to call it management of perceptions, to try to kind of steer an outcome by, it's like inflation expectations. Well, as long as everybody thinks inflation's only going up at 2 or 3%, then it will actually stay at just 2 or, that you can somehow manage everything just through expectations and perception. But at some point, the economic conditions become kind of self-fulfilling, because say you own a business and your neighbor just lost his job, he got downsized or laid off, and you hear of somebody else, and you're sensing, you're talking to your customers, things are slowing down, and you call your banker, and your banker says, oh, we're tightening our lending standards because of this, that, or the other, which is what they're currently doing. Mm-hmm. Now, all of a sudden, your business, you're like, yeah, maybe I ought to put off on that expansion I was thinking about. So now, all of a sudden, the construction company isn't building, they don't have the contract to expand your business. They thought you're not hiring the 10 new people that you thought you were going to hire this year. And the thing kind of becomes self-fulfilling at the grassroots level. Mm-hmm. Mm-hmm. And I think that's how we get to that vast majority. Because they're what, 90% of government bureaucrats are Democrat, right? Mm-hmm. So until we get maybe a Republican in the White House again, the data are going to continue to be inflated to make it look better. It's like every jobs report this year, Dave, has been above expectations. Oh. They were for 14 months in a row until last month. And all of them then were in the months later revised lower. Nobody cares by then. Oh, wait a second, it's 60,000 less. If it had been 60,000 less reported, it would have been below expectations in the markets and everybody would have reacted differently. But no, they just pump out a number and then revise it later.
And one of the issues I found that actually woke up a number of people, it took years, unfortunately, but when we had this recent Fitch downgrade of our debt, right? Yeah. Because the talking Muppets on CNBS and Fox Business News that have been pushing this mantra that, employment's great and the economy's great, they went silent. And that silence, I believe, woke up a lot of people because they were aware of this. Yeah. Wait a minute, if it's so great, why is this agency downgrading the debt? It's a major issue. Yeah.
Yes. And if the yield on the 10-year note, which is kind of the benchmark foundational investment around the world, if you hold dollars, mm-hmm. you probably hold treasuries, and that's how you're holding your dollars all around the world, governments and institutions. The bond has been getting sold, the note has been getting sold, and so yields have been going up. And actually, since that Fitch downgrade, it's gone from below 4% to today about 4.35,
mm-hmm. which is a big move.
Right. Very big. It's a 10% move, right? Yeah. And so it has real term impact, but all these people that are apologists for the current system and have a political angle and axe to grind try to tell you, no, this isn't a big deal. I would add to that, Fitch, since that happened, has also downgraded a number of U.S. banks mm-hmm. and their mm-hmm. credit quality. Mm-hmm. People, if they may recall from 2008, all of these rating, Fitch, S&P, Moody's, all of them stuck by their initial ratings of AAA on all this junk mm-hmm. stuff. Remember all the crappy mortgages that were plowed mm-hmm. into collective, they call them collateralized debt obligations or mortgage obligations, and then rated AAA, even though they were all, subprime mortgages. Remember all that?
I sure do.
And all those ratings agencies were eventually called to the carpet. Why were you, they congressional hearing, why were you calling this AAA if you knew there was, and then S&P responded, to the U.S. and, everything was going on in 2011 by cutting the U.S. to AA+. But Fitch and Moody's still kept it AAA. I think Fitch could see this coming. Mm-hmm. And they're like, we're not going to get caught, we're not going to get called the bad guy again this time. So Fitch has been kind of on this bender here for the last month of trying to, kind of subtly, hey, by the way, did you notice we downgraded this? Didn't get much press. Because they don't want to be caught, and called to the carpet again. I think that's what's happening. They can see what's coming, and they don't want to be the ones that pretended like they didn't see it.
Well, then we had Pam and Russ Martins, who are two of the finest financial writers around. They hit on this the other day. The 25, you mentioned the banks, the 25 largest U.S. banks are seeing the largest fall in deposits in 38 years with no signs of letting up.
Yes.
The talking heads on CNBS and Fox Business, why are these agencies downgrading the banks? That's not appropriate. They're fine. No, their deposit base is shrinking.
Right. And what this means even at your local bank, right? Bank will have a reserve requirement, mm-hmm. right? Mm-hmm. If you deposit $1,000, they've got to keep 10% in reserve so they can loan out 900 of your 1,000. That's how it works. That's how money gets created. That's, cash doesn't come from the Federal Reserve or whatever. That's money gets created at the bank level. That's how cash gets created, through all this loans and all this debt. So if you start seeing deposit flight, okay, it's a reverse of that leverage.
That's right.
And now all of a sudden you don't have the reserve ratio. Your reserve ratio falls under the stated limit or gets close, and the bank then has to start tightening, and not giving out as much credit going forward. Not only calling loans that are delinquent, but also, we can't go down this road. Actually, the Fed has a survey they put out once a quarter called the Senior Loan Officer Opinion Survey, SLOOS. Anybody can Google this. The most recent one came out a couple weeks ago, SLOOS. Just go to Google, type in Fed SLOOS, SLOOS, read it for yourself. It's not long. I mean, it's like 6 paragraphs. But this survey shows all of these bank loan officers tightening their credit standards and how much they're going to extend at the commercial and personal level because of this deposit. And why is there deposit flight? Because these bankers, pull out your statement, man. I could pull one out of my drawer on my desk, getting 0.05% on my savings account. When the bank can take that money and buy 2-year treasury notes at 5. Okay, they're not passing that along to me. They're certainly not giving people a break on their credit card or their mortgage rates.
That's right.
They're trying to capture that profit. Well, any wise, industrious person is going to go, well, screw that. I got $100,000 at that bank. I'm going to take it and stick it in a money market fund at, Vanguard or at my wherever and get 4. Now, gets back to phony baloney data. Dave, every Friday, late in the day, so nobody pays attention to it, the Fed, again, puts out deposit inflows and outflow numbers. Okay? The raw data has massive outflows, as you'd expect, from the banks. Billions and billions of dollars over the last couple of months, leaving banks, going into, these money market funds or wherever, right? The Fed, though, instead applies a seasonal adjustment.
Yeah. Right.
And turns it into an inflow.
Of course.
And says, well, normally, over the last 10 years or whatever, cash flows in this week in July or this week in August. So therefore, we're not going to take the raw data. We're going to assume we're missing a whole bunch of other stuff because seasonally, this is the time money flows into banks. Well, wait, what is the last weeks of July have to do with what's going on now with that spread between a savings account? Nothing. But if you can seasonally adjust it, then you can keep the narrative. You can keep the perceptions that everything's fine. Like, one last thing, Dave. On March the 7th, on a Tuesday, Chairman Powell was doing his semi-annual Humphrey Hawkins testimony. He goes up there by law, has the Humphrey Hawkins Act from whatever it was, 1970, whatever. Every 6 months, the head of the Fed's got to go up to Capitol Hill, sits in front of the Senate Banking Committee and the House Financial Services Committee, one day and then the other. So he's up there, March the 7th. He'll be doing it again, I'm sure, in September. And on March the 7th, he's up there talking, everything's great. The U.S. economy is robust. The banking system is safe. We're going to keep hiking rates, maybe even 50 basis points.
No troubled banks. No troubled banks on March 7th. But 3 days later,
here comes Silicon Valley Bank. He didn't know anything.
Yeah.
He was either lying or he's just completely in the dark. So these things are all lurking. All these problems are out there, these problem banks. And it can all change. The whole little nirvana they've created can all change in the course of a 24-hour news cycle. So people better be ready.
Well, let's talk about that 24-hour news cycle. Right now, when we're recording this interview, the BRICS countries started their meeting. It's a 2-day meeting. Brazil, Russia, India, China, South Africa, but 41 other countries are there wanting potentially to become affiliated somehow. It goes back to the first part of this interview, Craig, about, the dollar has always been the only reserve currency of the world. There is talk ahead of this meeting that, wait a minute, there could be some, not another type of reserve currency you put in your pocket, but a trading type of platform that's based on another outside of the U.S. dollar.
Right.
The bought-off lamestream fake media has been poo-pooing that, saying, "Oh, yeah, Janet Yellen, oh, it's not a big deal if that happens. If that not a big." No, Craig, tell me if I'm off. You're the expert, but if that does in fact occur, or something where they decide, amongst our countries, we're going to be working in the future here, in the near future, on developing a trade currency that we can use that's backed by gold or silver or oil or natural gas. Craig, that's an enormous deal.
Absolutely. And again, Mother Yellen, is right in the context of if they announce something, it's not coming out tomorrow. This is not a binary thing where you go from one system to the next overnight. Right. Okay, so you can poo-poo it all you want. This is a discussion that anybody listening to us can go ahead and have with your brother-in-law, over a beer on Labor Day. Mm-hmm. If you feel like they're not just nodding to go along, and thinking, oh God, here comes another crazy talk. Okay. If they have the capacity to actually think this through, then you can have this discussion with somebody. This is just basic economics. I think most people understand supply and demand, mm-hmm. right? Mm-hmm. If you have a bumper crop of oranges, mm-hmm. in a year that they decide that orange juice is carcinogenic, you're going to have this huge supply of oranges, mm-hmm. No demand for oranges, mm-hmm. and the price of oranges is going to collapse.
Correct.
Right? Mm-hmm. Okay.
Mm-hmm.
I just mentioned $50 trillion of debt.
Yep. By
10 years from now. That $20 trillion got to come from somewhere. Yep. It's going to be created from scratch, right?
Bumper crop of dollars.
Bumper crop of dollars. As long as there is demand and increasing demand for dollars, mm-hmm. okay, then there's still some level of equilibrium, mm-hmm. right? Mm-hmm. The problem is these BRICS countries have figured out that if you get sideways with the U.S. will use this global financial system against you, sanction you, right?
So that in March of 22.
Right, exactly. It's like what happened to the Russians. Now, again, we're not talking about whether the Ukraine war or anything like that. It's just the fact that the Russians decided that they had an interest in invading mm-hmm. Ukraine, their own national interest. Mm-hmm. We decided we mm-hmm. control the financial system. We don't like what you're doing, mm-hmm. which is fine. We're going to cut you out of the financial system. Mm-hmm. Well, other countries take that as a sign and go, well, wait a second. Right. If we do something that we think is in our interest, but the U.S. doesn't like it, they're going to cut us off from access. Well, why don't we come up with a different system? And that's what these countries are discussing. We're in the current system. Let's say, I picked two countries, Dave, the Philippines and Vietnam. And they want to trade between. Vietnam's going to sell some of what's being made. A company in Vietnam, something going to sell something to the Philippines. Well, if you're that company, you don't want to take on the risk of the Philippine currency.
Right.
And vice versa. The mm-hmm. Philippines don't want, the Vietnamese dong or whatever it's called. Right. So they transacted in dollars.
Right.
Instead. Okay? Mm-hmm. So think of that as creating global demand mm-hmm. for dollars. Mm-hmm. Mm-hmm. If and when in the future, those countries don't have to use dollars anymore. Mm-hmm. They'll use this new trading instrument that the BRICS are developing, and they back it with gold or crude oil or a basket of whatever so that it has some stable mm-hmm. backing of it, unlike the dollar, which is backed by debt and the U.S. military. That notwithstanding, whatever backs it, if there's just something else that they can use, mm-hmm. now you're losing demand mm-hmm. for dollars. Mm-hmm. At the same time that supply is increasing. Mm-hmm. And just like those oranges, the value of your oranges, the value of your dollar starts to fall dramatically. You think inflation is bad now. Mm-hmm. Okay, as this plays out in the years ahead, that's when, it's going to get pretty crazy.
Historically, when inflation gets crazy, hyperinflation, for example, two entities that have always done well, maintain purchasing power, has been gold and silver. Mm-hmm. So you're having this discussion with your brother-in-law at the Labor Day picnic, and he goes, well, yeah, but those gold and silver market. I get it. I understand where you're coming from on this reserve. I understand about you want and backing it, and But I'm hesitant about getting involved in gold and silver because they have been criminally manipulated for decades. And, well, yeah, I know the whole financial scene is a bit, crazy and off. But, hey, I put some money in NVIDIA last year. And my gosh, I'm making out like a banshee. And so I'm just concerned that to put money into gold and silver, it's just going to get criminally manipulated and just, there'll be some gains, not so much. There'll be downturn. So what do you say to your brother-in-law when he comes back with that response, Craig?
Again, that's fine. Hey, trade as much NVIDIA as you want. Your savings, however, your whatever's in your bank account, whatever's in your money account at your brokerage firm is in dollars, just sitting in dollars. And those dollars are being devalued and wasted away by this inflation and everything else that's going on. So if you want to, as long as you can beat inflation by trading your AI stocks or whatever, well, fine, great. You're diversified to some extent. But some of your other savings, your net worth, should instead be in something that is not being devalued all the time, that isn't being printed into infinity the way the dollars and the other paper currencies are. And so I would kind of frame it that way. And I would further say, yeah, no doubt. I mean, the convictions have been made about these banks and how they manipulate for their own profit the prices of these metals, and it's still ongoing. But all that's doing is creating a bargain. There's this illusion that somehow the price that you see that's created through the trading of electronic trading of these futures contracts is somehow the true physical supply demand price of precious metal. All they're doing is they're keeping prices down, which works to my benefit, which works to your benefit, because once a true price is determined, when this system blows up for lack of actual physical metal, it's not going to be $23 silver. No. It's not going to be $1,900 gold that stuff is selling at. And it will then see you through the storm of all of the, and I should further state, even in the face of all of this, all of the phony baloney shenanigans of all these markets, go back to the year 2000 or 2003, gold was $300 an ounce. 20 years later, it's up sixfold, even in the face of all this stuff. So things aren't getting any better over the next 20 years. What's another sixfold increase from here? 12,000? I guess, yeah. Yeah. Okay. If you have ounces, if you just manage to buy yourself 1 ounce of gold a year, over the next 10 years or whatever, you're going to be building a little stockpile to guard you against all this monetary madness.
And Craig, one of the many benefits of your platform is you dissect what's happening behind the curtain with the data that the vast majority of the public is unaware of. So when you look at the specifically gold and silver markets now, and you look at the data, the commitment of traders information, where the hedge funds are, where the big boys are, what's it telling you?
Well, we've had a really challenging 5 weeks or so. Gold's down about $100, silver's down a couple of dollars. And it's because of, the machines, the computers, and a few random humans, I guess, have seen where interest rates have gone up. That has dragged the dollar index, where, when people say the dollar is strong, they're referring to this index that compares it to a bunch of all the other paper monies around the world, the euro and the yen and the like. And so they react by selling these futures contracts, and price goes down. And that's what's happened in the last 5 weeks or so. But that's about run its course. What I can do, in the 12 years, 13 years I've been doing this, you can actually monitor what's driving just in the little bit of data that you get about market internals. And at present, all of the hedge funds and managed accounts and individuals that trade gold and silver futures have been selling what we call their long positions, where they're hoping it goes up. That's driving price down, but then they're establishing what we call short positions, where you can actually sell first and buy back later in the hopes you buy it back at a lower price. Well, all those entities are doing is setting themselves up to get what we call squeezed, where you're forced to buy back that short position at a higher price instead of a lower price. And then they start chasing and getting long again. Anyway, we've seen this happen. I've seen this happen, oh my gosh, in the last year, 4 or 5 times, multiple times over the last 12 years. Mm-hmm. And it's just happening again. I get the point. Look, I don't want to confuse people and make it seem like this is more than, you can handle. All it really means, and all I primarily do for my subscribers at my site is like, look, if you're going to say you've been listening to Dave and I, and you're like, yeah, you know what? I think I will buy some silver. Well, if I'm pretty sure that silver has probably seen its lows here below 23. So if I'm right, and you can buy, a tube of Eagles, silver Eagles, little round coins at 23.50 instead of next month at 24.50, then I saved you $1. I just saved you $20. Mm-hmm. You can now buy 21 of them instead of 20. Mm-hmm. And so that's where understanding how these markets work, the forces behind them that drive price up and down, is not related to physical metal and physical supply and all that kind of stuff. Mm-hmm. If you can understand that, then maybe I can save you a little bit of money. In the meantime, we're stacking physical metal someplace safe, in your own safe, at a trusted depository something, and you're building this supply of hard money. That can't be diluted, that can't be just printed into infinity to fund the debt. And that will protect you. That'll be your boat through the storm, or at least help. For all the stuff that is, like as we began this call, that is inevitably, mathematically certain to be coming.
Well, and if you just look at what the banksters are doing around the world, just a couple data points here. Central bank gold demand in the first half of 2023 was the highest on record.
Yeah.
The German central bank gold revaluation account underlies the soundness of our balance sheet. President of the Bundesbank said Germany's gold reserve assets are a major anchor underpinning confidence in the intrinsic value of the Bundesbank's balance sheet.
Yeah.
And then J.P. Morgan, no less, projects record gold prices in 2024. Kind of interesting. For many years, they are at the hub, and they've been found to have criminal convictions against them. They had to pay. Nobody went to jail, unfortunately, but they had to pay a lot of fines. Many millions of dollars, hundreds of millions, maybe a couple $billion in fees and fines for their criminal manipulation of the gold and silver market. Yet they've been accumulating, and now they're telling people, don't listen to those headlines about us criminally manipulating the market. Listen to what we're telling you now. Yeah, it's going higher. They're going higher.
Yeah.
Right.
Yeah. Dave, this gets back to what would you tell your brother-in-law?
Yeah.
I'm making all this money, and in the video, remember I said, well, what are you doing with your savings?
Right.
Global central banks, not the U.S., certainly not Canada. But yeah, you go to Germany or Kazakhstan or, India, Turkey, global. What are they central bank demand for physical gold the last 2 years has been the highest it's been since the late 1960s. Why? What are they doing? How are they getting money, cash, to buy gold in the first place? Okay. A central bank that has cash is taking their dollars or whatever, euros or whatever, and they're exchanging it for physical gold and holding some physical metal in their reserves instead. What did I just tell you to tell your brother-in-law?
Right.
Take some of your cash and instead of holding dollars, hold some physical metal instead. Okay, so you're not crazy for doing this. These are allegedly some of the smartest people in the world, these global central bankers. If they are taking some of their excess reserves that are in cash and buying physical gold, why would you as an individual not take some of your excess reserves of physical cash, your savings, and do the same? That's what these countries are doing, and that's what individuals should be doing as well.
And unfortunately, there are some people that say, I got to learn more about the system. I'm going to read the Wall Street Journal. I'm going to watch CNBS. I'm going to watch Fox Business News. Craig, the information people are getting there is keeping them so wrong-footed.
Yeah.
And I will conclude our time together today with this. I mentioned to you beforehand that yesterday, and you do the same thing, we watch these outlets of misinformation, so we know exactly how they're getting people wrong-footed, so we can address it. Yesterday, we just mentioned about the criminal manipulation, in particular through J.P. Morgan Chase, well-documented, criminal fines and the like. I'm watching Fox Business News, and Liz Clayman on her show, I don't know what her economic background is. Oh, wait, I don't think she has any. She launches into this diatribe about how, quote, direct quote, so Jamie Dimon, the CEO of J.P. Morgan Chase, that has been found to have been criminally manipulating a multitude of markets, not just gold and silver, but the LIBOR market, and you name it. Quote, Jamie Dimon, the CEO of J.P. Morgan Chase, will make a wonderful president, and everyone here at Fox Business News agrees with me, end quote.
Well, let me go backwards for a second.
Yeah, go backward. Yeah, right.
I'll tie this back into that statement, I promise.
Okay.
And I won't take forever to do it.
No, that's fine.
I'm certain your viewership, everybody watching us, that on your channel, now understands the role of big pharma in the world, right? Mm-hmm. Right? And the vaccine for COVID, which is made by Pfizer. Mm-hmm. And then you watch the news or you watch any programming, even sports programming, and it's sponsored by Pfizer. Mm-hmm. And we begin to see, wait a second. I'm being told the news that's sponsored by Pfizer, and the news is pro-Pfizer product. And no one seems to, and I think we've all kind of, especially on your channel, people are awake to that? Yes?
Mm-hmm. Mm-hmm.
Okay.
Absolutely.
So everybody can connect those dots. But you turn on CNBC or Fox Business, and all of the sponsors, the commercials are from financial services companies.
Yep.
And nobody seems to think that maybe that doesn't impact what you're told on those. You can see it happening on the news channels, but you think it's not happening on the financial channels? Look, all of those just like same business, Pfizer's going to benefit by advertising, getting people to use their product, not just the COVID vaccine, all the funky names, products, ubabadibadabab. You say, well, how the hell do they even come up with a name like that, right? Mm-hmm. You got all these fancy products. Ask your pharmacist about how ubabadibadabab can solve your arthritis. Everybody can connect those dots, but it's the same thing. Mutual fund company, brokerage firm, investment house, they all advertise on CNBC. And how do they make money? Fees. Their fees. They collect 1% a year on your assets that you have them manage. Well, how do their fees go up? Well, their asset base has got to go up. They can have people move their accounts in, but if you can get the markets to go up 20%, your fees are going to go up 20% on a static account base. Mm-hmm. So they've got a reason to promote, everything's great. Everything's fine. Got to be long. We're going to tell you only the positive stuff. We're only going to tell you the headline number, right? And so like I said, everybody can see straight through now how Pfizer and the drug companies control the news flow about health information, but nobody wants to believe that the financial services firms can control the information, the news flow on finance. It's the same freaking thing. Mm-hmm. So why does Liz Clayman and everyone she knows think Jamie Dimon would be a great president? What do you think? How do you think Jamie Dimon would run the company from a financial standpoint? Right? Going to keep them all rich. Going to keep them all in power.
That's right.
That's all it's about these days. Mm-hmm. Money and power. It's end of empire stuff, Dave.
Yeah, it sure is.
Why is Dianne Feinstein still the senator from California? Because if Gavin Newsom, if she quits and Gavin Newsom's going to appoint somebody, a Democrat, that's not who Nancy Pelosi wants to have the seat. That evil Adam Schiff guy. And so they keep rolling Feinstein out there.
Right.
I mean, it's all about power, and
It
it's
is.
all about money.
That's right. Power, control, and money.
You're going to continually be told messaging that reinforces their hold on power and their hold on money. Mm-hmm. And so it just you cannot have an empire built on a foundation of lies and misinformation. It'll collapse just like a house of sand, at the beach when the tide comes in. So, Dave, I applaud you for doing what you do. I just keep doing what I do. We're going to try to continue to warn as many people as possible, to many people to listen, so that they'll prepare for when this eventuality hits. And it is a mathematical certainty. Mm-hmm. You're either going to be left holding the bag, or you're going to be prepared for it. It's not any more complicated than that.
So, Craig, educate our listeners on your platform and how they can subscribe to tfmetalsreport.com.
Well, I don't know if you can see the fine print. We've been doing this now since 2010. I'm not a know-it-all. I mean, I've been expecting prices to rally this, in the second half of this year, and they're certainly not rallying yet. I'm no smarter than anybody else, but I can do the math. Mm-hmm. And we've been talking about this since 2010. What I don't know is what's that terminal number? Mm-hmm. If you'd have told me we get to 32 trillion in debt from whatever it was 12 years ago, 15 or 10, there's no way we can handle 32 trillion. And maybe we can handle 50 trillion as well, somehow, under the same system. But I do know that moment is coming. So we've been preparing for that now for 12 years. I provide analysis. I'm your eyes and ears. I write every morning about here's what's going on today. Here's what happened overnight. I provide a podcast every day. If you haven't been able to pay attention because you're busy doing all the things that you're living your life and you want to know what happened, well, stop by and I'll give you a podcast you can listen to every night as well. The main thing is, though, too, the community from people around the world, all political stripes. Mm-hmm. I mean, we're all in this together, and so we all try to help each other out. So to have access via the internet to this diverse community and their perspectives and their opinion, the news that they find and share, that is, I don't even think you can put a price on it, but I do. It's 50 cents a day, $15 a month.
Well, Craig, tfmetalsreport.com. Craig, I'd like to thank you for everything you have done, are doing, and will do. Your perseverance, dedication, and sacrifice are incredible, and they help millions of people around our country and around the world that are willing to open their eyes to the reality of the financial empire of lies and how to protect themselves. And I thank you, Craig. And I thank you folks for joining us. Until next time, Dave Janda signing off. Dream big and dare to fail. Thanks for your time today.